Refinancing your home because you're behind on your mortgage right now, that's usually the first thing that comes to mind. Lower the payment, reset the loan, fix the problem. But what if in your situation, trying to refinance might not work and it could actually cost you time that you don't even have? And this is exactly how people end up getting pushed closer to foreclosure without even realizing it. Because this is where most people get tripped up and end up frustrated. When you really look at a refinancing, it's a brand new loan. So the banks not looking at who you were before things got difficult. They're looking at you right now, today. And today you're behind. Your credit probably took a hit. And depending on how far this has gone, there might be already something like a list pendants tied to the property. So just think about that for 1 second. You're asking the lender to approve a brand new loan while you're already struggling with the one that you have. That's where this starts to fall apart. Most people don't see that until after they've already spent weeks trying. So now it becomes, all right, if that's not going to work, then what does? A loan modification is something that's actually meant for this situation specifically. And this is the part that gets overlooked the most. And don't overthink the term. You're not starting over. You're staying with the loan you already have. Same lender, same account, but now you're asking them to adjust it. So instead of trying to qualify for something new, it's more like asking, can we make this one work? And that can mean stretching things out, adjusting the rate, working the missed payments out into the balance. The goal is really simple here. Get the payment to a place where you can actually keep up with it. But here's the part that doesn't get enough attention at all, and that's timing, because this is where people think that they still have room, and that's not always the case. You might be looking at this like, all right, I'll try this. I'll figure it out. I've got some time. But the process of foreclosure on the other side is already moving, even if it doesn't even feel like it yet. So this is where it starts to matter the most, because if you go the refinance route, you're stepping into something that takes time. There's underwriting, there's an appraisal, there's back and forth. And that can take weeks, sometimes even 45 to 60 days. And at the same time, depending on where you are right now, the foreclosure side is on its own timeline. And if you've already been served in New York, you're usually looking at about 20 days to respond. And if you're in New Jersey, it's closer to like 35 days. So now you've got both happening all at the same time. You're trying to get approved over here, while over there, the clock is still running. And this is where the difference starts to show, because when you go to the loan modification route, you're not starting a brand new process somewhere new. You're working directly with the lender that already has your loan. So instead of trying to get approved from the outside, you're dealing with the situation from the inside. And once you actually submit a complete package with everything they're asking for, things usually starts to slow down on the foreclosure end of it. Not forever, but enough to give you time to figure out your next step. And that time is what most people think that they have until they realize that they don't have it at all. Because once that time is gone, it's a lot harder to get it back. And I've also seen the other side of this, where someone thought that they were getting help with a loan modification, and it went completely sideways. I broke down a real situation like that here in Staten Island in another video, just so you can see how quickly it can go wrong when it's handled the wrong way. And that's why getting it done the right way matters so much. And let's just say somehow the refinance actually goes through, because that does happen on occasion. I'd still want you to pause for a second and really look at it. Now you've got closing costs, a new interest rate based on where things are today, and a new balance that probably rolled everything into it. So the real question becomes, what does that payment actually feel like every month? Not on paper, but in real life, because I've seen this play out. It works at first, things feel a little more manageable, and then a few months go by, something goes wrong again, and the payment doesn't hold anymore. And now you're right back where you started, behind again, but with fewer options left to fix it. That's the part people don't see coming. It doesn't fall apart right away. It falls apart later, when there's less room to adjust anything. So if you're thinking that the loan modification makes more sense, the next question on your mind is, then why do people still get denied for that? And this is where it gets frustrating, because a lot of the time, it's not that you don't qualify for the loan modification. It's how the file was put together, especially the hardship letter. What you say in that letter, how you explain your situation, what you include without realizing it, that's where approvals get lost. So before you send anything in, I'll walk you through exactly how to structure that letter, what to say, what to avoid, so you don't get denied over something that could have been fixed ahead of time. Watch this next video, because right now, getting that part right can make all the difference in how this turns out for you.